Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly review for the week ending September 29th, 2023. Looking at the markets this week, lots of red. It's still the strength of the US dollar that is wreaking havoc in some markets. We see Canadian dollar down, euro down, price of gold down 3% on the week, still up on the year, but gold has been resilient in the face of a higher USD for most of this year, but now it seems to be catching up to it, so the prospects for gold might be a bit sketchier right now. When you look at interest rates higher, has a lot to do with the price of oil that continues to push higher or to stay at a high level. This is fueling inflation expectations. This is fueling bets of higher for longer from central banks. So higher interest rates and higher interest rates fueling some red again on the week for the US stock market, although we're looking at the positive day here. Maybe the script will flip at the end of the week, but September shaping up to have been a pretty tough month in equity land. Maybe let's start with oil. So low oil inventories are pushing prices to worrying levels. We know that OPEC Plus, led by Russia and Saudi Arabia, have been cutting production to keep prices higher and also to help in lowering the overall level of inventories, and it seems to be working so far. If you have low inventories around the world, less production, that gives you a floor under the price of oil. The floor might be somewhere around $80-$85, something like that, but we are seeing the price of oil rebound, and it's nothing compared to what we saw in 2022, but still we're seeing this rebound here, which is starting to worry investors and fuel again, as I said, the inflation expectation, and it is having an impact on all asset classes right now. But on the right, what you see is the US crude oil stocks are now close to the lows for this season. So in the chart here, the blue line is the level that we have here, and the gray area is the 5-year range of the max and the minimum for this every single specific date. So here we are with low inventories fueling higher oil prices, and this is having an impact on consumer confidence but also business confidence. And when you look at this week in Canada, we had the CFIB Business Barometer Index coming out. We're at the lowest level since the period that we saw in the great financial crisis. Businesses are getting less and less optimistic out there, and the number one factor now, going to this other slide here, is energy costs that are causing difficulty. So there's a question in the survey: what is giving you the most worries, causing the most difficulties? And now energy costs have taken the crown, rising here, still not at the levels that we saw in 2022, but a strong jump here. And this is showing that the businesses are now more worried about energy costs than labor shortages, as you can see here. So on the left here, you have the worries about the shortage of skilled labor, which is slowly grinding down, but steadily grinding down. And on the right, intentions to increase staffing, also falling. So businesses are looking at a weaker economy ahead, feeling that likely they won't have to hire as much as they did recently. So if you intend to hire less, likely you're less worried about the shortage of skilled labor. It goes hand in hand, but also it could suggest that the hiring sprees that we've seen recently could end. Maybe they could reverse even. So businesses are not right now very optimistic about the business, the economic perspectives in Canada. Flipping to the markets now, there's this narrative and a question that we've been asked quite a bit recently. We've been asked, well, the S&P 500 or the global stock market, but specifically in the US, is telling us that the soft landing is coming. The US stock market is sending a signal. The market knows something that maybe we don't. Well, we have an issue with the idea that the S&P 500 now is hinting at a soft landing. When you look at the performance year to date, here you have the blue-green line on top here. This is the Magnificent Seven. So I might forget the name here, but this is NVIDIA, Amazon, Apple, Tesla, Microsoft, Google, and I'm forgetting one. This is what I thought would happen here. But the 7 big names that are linked to artificial intelligence. And if you look at the performance this year, of course, these names were left for dead in 2022. They were out of favor. They started out of the gate pretty strong in January. But then came ChatGPT and the exuberance around artificial intelligence. And I use the word exuberance purposefully here because we still don't see any business that is clearly reaping the benefits of AI. Maybe Nvidia with their sales, but there's lots of forecasts there. But it's not like AI is yet making a dent in the earnings of these firms. It's more forward-looking. I think Amazon is the name that I forgot earlier, but maybe not. So we at some point these 7 names had a cumulative performance of about 70% somewhere in July. Now we're seeing some profit taking, still very healthy 50% year to date for sure. But when you remove these names from the index and you look at the 493 other names, you get the gray line at the bottom and you see that there's pretty much zero return year to date. So if you compare that to alternatives, or if you look at the Sharpe ratio, well, when you have 5.5% returned now from short-term bonds, a 3-month rate, that means that you have a negative Sharpe ratio from the US stock market. So the US stock market is not telling us that there's a soft landing coming. What it's telling us is that this year was the year for the big names, the biggest weight in the index, based on something that is speculative for now, but it's not really a macro signal that we should listen to. Moving to bonds now, well, another, although it's been a windy road since, well, let's say early 2022, bonds now offer attractive value. So on the left, you have the US 10-year rate. On the right is the Canadian 10-year rate. On both cases, rates are very attractive now, the highest since pre-GFC of 2008. So, you know, it's we are buying on weakness. We continue to think that the rates that are offered now are very attractive when you look at the correlation through time of returns of fixed income versus, you know, how the correlation with other factors. Well, it's mostly the yields when you purchase the bonds that will determine the returns. Of course, it seems obvious, but you also have the capital gains, which can play which can come into play here. But these can be volatile, but you can almost lock in very attractive returns at this point. It still looks like a falling knife. We don't know exactly how to time this. No one knows. What we do know, though, is that it pays to add on weakness when rates are becoming this attractive for bonds, and this is a strategy that we're putting in place in our funds. So what to watch next week in Canada, we'll have the net change in employment and the unemployment rate. In the US, we'll have the ISM manufacturing and services index sideways or lower. Jobs creation should be a bit lower at 170,000, so still positive but lower than last month, and unemployment rate should be lower at 3.7% in September. So that's wrap it up for this week. ia.ca/economy to get this review and the podcast. If you want to have more deep insights, well, iagam.ca/insights, you'll find our monthly there and material from our colleagues at iagam. So take a look. Always a pleasure to serve you, and I'll be back again next week.